Hi, everyone. Welcome back to The Big Picture. So last episode, we debuted our co-host, Marty, who's going to be joining us on the podcast alongside myself and Greg from Amber Data on a regular basis. Super pumped for that. Super excited for that to be the regular hosting squad going forward. And today, in terms of guests, we're joined by Simon and Junseo from QCP. So QCP, it currently holds the title for the highest market maker volume on Paradigm in 2023. So congratulations on that, guys. You guys have been amazing partners for us at Paradigm. Really pumped for today's episode. And I think I speak for everyone at Paradigm. Really excited to be working with you guys on a go-forward basis. But before we begin, smash that like button, hit that subscribe button. We got an amazing episode for you guys with some of the best commentary and some of the best guests, as you can see for today, that you'll find in the crypto derivative space. So I guess just to start, Simon and Junseo, if you guys can give just a quick intro on your background and how you guys ended up into crypto derivatives at QCP. I know we did an episode, 5 or 6 months ago, but it's a good refresher for our viewers.
Yeah, of course. Perhaps I'll kick off. So, thank you very much for a start. It's been a great partnership, and we're super happy with our relationship with Paradigm. It's the dominant place, the only place to do to execute crypto options in the institutional world. So, well done, guys. My background, I was running FX options at BNP Paribas, and then Standard Chartered out here in Asia. Been doing that for quite a long time, and switched over to crypto 3 years ago, actually 4 years ago. Started off trading for myself on Deribit. It was like, wow, fantastic market, and made some decent money there. And then as things scaled up, I realized that time to take off the gloves and do things a little bit more institutionally, and joined up with QCP to set up a market making operation for them, which is what we've been growing with our star talents, Junseo, over the last couple of years.
Awesome. Just say I want to just give a quick 30 seconds to a minute.
Yeah. Well, hey guys, I'm Junseo. I'm actually a Korean, but I've been in Singapore for a long time, so people mistake me for Singaporean. But I joined QCP like 3-4 years ago, and QCP was my first workplace. I joined when I was still a uni student. Darius took me in, and I was a trader. And after Simon joined QCP, we scaled up the market making business, and that's when I worked super hard to, make money and scale the business.
Okay, awesome. Well, thanks for the intro, guys. And I guess we'll just jump right into kind of what we're seeing. So, I think the first thing that would be interesting to discuss as a group is kind of this repricing and skew. So in 2023, generally the 25 deltas has been trading calls over puts for most of the year, outside of a couple occurrences, for example, around the Silicon Valley banking crisis. But, with this move lower in spot, despite the positive grayscale news, we've actually started to see a lot of the 2023 buckets trading puts over calls for the first time in a while. So I know, Greg, you wrote about this in your latest alpha piece over the weekend. So I'm curious to kind of hear your views around it and, potentially opening up, and how would you take advantage of a sort of move like this?
Yeah, absolutely. Thanks, Joe. Let me share my screen real quick. There's another chart I like to just annotate here, if that works. So one of the things that I find really interesting is the relationship of the put skew versus at the money for ETH. So this data goes back to 2019, April 2019. What we're looking at on the orange line here is the 25 delta put for 30 days till expiration divided by at the money vol. So you can really see as a percentage of at the money vol, how expensive is that 25 delta put. So what that's really showing us is that there's a lot of steepness in the wing relative to at the money vol. At the money vol is also historically in the lower range than we've seen in a long time. And right now it's really interesting because prices are a little bit weak. So these put put spreads get really interesting. You buy the at the money put, sell the 25 delta put against it. It's kind of a really interesting relationship. And that's what I was talking about in our weekly newsletter. I think obviously we saw a little bit of downside on the potential of FTX selling assets. We'll circle back to that later. I'll let some of the other folks talk about that, but that's kind of interesting perspective. And that's kind of what I'm seeing right now in the market.
Right. So kind of just to explain explain that chart. So in terms of why you're looking at skew on a normalized basis relative to at the monies is because when vol is higher, you would expect skew to generally be wider, right? You're on a higher absolute level of vol, so differentials between vols would generally be higher. But so you basically are normalizing that skew by dividing by the at the money vol. Is that correct?
Yeah. So I'm normalizing by dividing by at the money vol. And I think really sort of it's kind of pricing the convexity. So the wings being so much more expensive, I would actually kind of expect that in a low vol environment because we go from low vol to high vol, things quickly change. So there's a potential for a high vol of vol scenario, so to speak. So the wingy options should be a higher premium relative to at the money vol. So it is a function of a lower vol regime. But I still think it's pretty interesting because we're not seeing that same type of pricing in Bitcoin, the same type of extreme pricing in Bitcoin. So that's really where I think ETH has sort of a hidden opportunity. And then the other thing, we've talked about this a few times, I still think the ETH Forwards are overpriced, given that ETH is a passively yielding asset right now. I think what's happening is ETH call overwriter is managing margin by hedging using the perpetuals. And so that's translating in sort of a funding going through the curve. And so there's kind of a combined effect there. One is, if my thesis is correct, that ETH Forwards are maybe overpriced, well, then that at the money vol or that at the money option is a little bit underpriced. And then combine that with a pretty steep wing, all of a sudden put spreads get pretty interesting. And then we have sort of the backdrop of the environment. Prices look a little bit weak on the delta bias. So altogether, to me, that's an interesting sort of trade. And that's where I see value right now.
What do you guys think over at QCP about this move?
Yeah. I suppose we have to break it down into a few things. Negative skew, negative risk reversals is what we look at. There's nothing too exceptional about that. We saw negative risk reversals during most of last year, especially pre and post events. To anyone coming from the equity world would be sort of very very familiar with that shape curve. We're actually at very modest levels of skew right now. During the pre FTX, we were up at 20, 30 vols differential. Yeah, admittedly off of a much higher at the money handle, as Greg sort of pointed out. But that was a market that was genuinely fearful of the downside, trying to hedge Genesis type loans and things by buying puts, and it was really sort of scared of that gap move. I think what we're seeing right now is a little bit of a return of that fear, but mostly now it's about discounting the calls. And you mentioned particularly in ETH, right, where we're seeing the heavy interest by overwriters to sell November, December calls. That's where we've seen the biggest skew move. Resulting in this shape of curve. So overall, I'd say probably the risk reversals are quite sensible, given where spot is and the risks that we've got coming up. And they generally sort of explained by flows. One thing that I think is interesting, if I sort of go down my list of potential surprises over the next quarter, we've got Mt. Gox, FTX, ETFs, hardening rate moves. It does seem to me though that most of the most of the negatives have been priced in, and if there's a shock, if there's a surprise, it's generally going to be. It looks like the shocks are on the top side potentially. So, looking at the risk reversal trades, I prefer to own calls at this level.
Right. Interesting. And let me just share my screen very quickly.
Sorry, and full disclosure, we do own calls at this level. So.
Yeah.
Thank you for the disclosure.
Yeah.
Yeah, for me, it's been pretty interesting while Joe's sharing his screen.
Yeah, go ahead, Mark.
We run a smaller book, right? We're like sub $20 million, so we're nowhere near you guys, right? We're more pro-tailed and full institutional. Still have a small team. It's been very interesting. I write these bi-weekly newsletters, and I've been trying to find a catalyst that we didn't have already, right? We had, I think we talked about it before on this show, we had the XRP, we had the grayscale, and it seems like these just crypto-specific shocks, right? We already know the macro, we already know the rates, unless something major comes in, like a black swan or something. I mean, the not the fear, but the excitement is to the upside, right? You're seeing this in people buying outright call spreads, and only buying more short-term protection from what I've seen, where you're seeing these very long-dated, kind of more moonshot, just picking up as much cheap upside as they can.
Yeah,
I like your little
go ahead,
around October top sides. We're seeing the same thing there. Definitely there's a lot of focus around October right now and the sort of potential for it.
Yeah, exactly. And so effectively, on the upside front, so this is a paradigm Bitcoin heat map. So basically what we do is over the date range, in this case, September 8th to September 12th, we basically look at the net cumulative taker interest of what is occurring on paradigm, and kind of exactly what Simon just said, right? I mean, look where all the green is. All the green is in that October bucket in the strikes of 28.5 to 33K. The October outright call buying has been pretty relentless this week. And I think on Greg's point as well, around like the put spreads, around how them looking a bit more attractive, given the move in the skew, a couple of the notable prints that we've been seeing on the downside has been, these SEP like 23.5, 24.5 put spreads. Those traded 600 times on us, or, the September 22nd, 23K, 24.5K put spread also traded on us last week. We hadn't been seeing a lot of, put spread downside interest in, at least in decent size as of late. But, given the repricing of this put wing and, potentially funding that downside protection via this wing, as is continued to reprice higher, perhaps makes some sense. So it's kind of interesting, right? Like, it's not, you see people trying to, effectively kind of fade the move in the skew a little bit, kind of like, selling the downside, buying the upside, given the upside catalysts that are certainly in play. So I guess maybe the next topic, Ethereum Bitcoin spreads, those have continued to widen to the point now, what I think Ethereum in the 1 month, 2 month buckets is trading 5 vols to 6 vols under. Do you think this is kind of like, the new state of world that we're in? I mean, I remember, a few months ago when this thing was trading at flat, and then you had people coming out with trade ideas to basically play for a reversion in that, but it's continued to basically just go one way.
I mean, right now it's like all the attention and flows has been focused on Bitcoin, especially the catalyst. So, I mean, you can tell from the flows, Bitcoin flows are much more heavy than ETH, while the ETH is like mostly offered on the screens. So we can see the spread actually widening further. I mean, to be honest, we have been running the long Bitcoin and short ETH spread since like when ETH was trading in premium to Bitcoin. And we can actually see it widening further. One thing I would like to add is the seasonality that we have in September. Like, September is usually the down month for Bitcoin. and there you have like October. That's why you can see a lot of people were panicking and buying all the low delta low delta puts and put spreads when things broke 25.5k, which was very pivotal like support that we had since last year. Like it remains as a key level, and most of the moves are driven by the leverage market. Like you saw the OI being wiped out on the longs, wiped out on the shorts. So we saw a huge round trip since like Grayscale news and this week. And that's the thing, like when leverage market is taking over, you are likely to see more volatility and extended moves. So I think that's why we saw some panic in the downside that we had a couple of days ago. Yeah. And back to the BTC and ETH spread. We still think the catalyst for Q4 will be on the Bitcoin side, especially on the top side. And yeah, I think it's like what Simon said already on the calls, and it should be a buy for October, December bucket.
Right. So now, I mean, you look at like the paradigm net taker open interest, and there's significant open interest in, I would say, the Q4 sort of maturities in the 30 to 40K strike range. And I know Greg has done a lot of work around, like the Gvol GEX, which is his basically way to measure the dealer gamma in the market. So I'm curious to kind of hear, especially, from a market making perspective, because at least in Ethereum, so I have Ethereum up now. I know we were just mentioning Bitcoin, but according to this chart, this suggests that dealers are long gamma. But I'm curious to kind of hear your guys' perspective on it, as well as Greg or Marty, if you guys have any views.
Sure. I just want to say for this chart, Greg, maybe you want to give like a 30-second elevator pitch on why yours looks different than like some of your competitors. Because I know I read about this before. I know you wrote an article about, but for somebody who's never seen this chart before, maybe you can give an intro.
Sure. Yeah, absolutely. So basically what we do is we marry times and sales data with order book data, and then we essentially look at the pre-order book state right before a trade and post-order book state right after the trade. And then from there, we have a bunch of different rules. We look at the impact on open interest, where the vol traded, where mid was, pre and post, things like that. Stick it in a matrix, and from there we have a really good estimate of the aggressor of the trade, and then we assume that market makers are passive. Then we look at every instrument since listing and tally up all the trades and get a really good estimate of the dealer positioning in that particular instrument. So this chart is ETH options across all expirations by strike as of September 11th, a couple days ago. And so what it shows us is that theoretically, assuming this is correct, which I feel pretty confident that it is, but I'm curious to hear what the QCP folks have to say. Basically, dealers would be long a lot of ETH optionality, especially between, call it, 1,575 to 2,100.
Yeah, I'd say that looks pretty accurate. I mean, again, disclosure, I'm not. But if you look at general behavior in the market, overwhelmingly we see gamma supply in both BTC and ETH. So on any one day you would expect the sort of the passive price providers, the market makers, to be generally long gamma. I don't think. Right now we've sort of moved out of the sort of sticky areas at 1,800, 29K, 30K. So I think in terms of strike risk, it's reasonably clean, and you see that reflected in the shape of the vol curve, right? We're pretty flat now, out through to the end of September, which you wouldn't normally see when there's sort of been a long period of heavy activity. I think probably the main area where there's supply right now is probably more on the BTC. There's some very heavy selling of short-term calls there. Last few sessions we've seen some good buys of October, as Greg shared. So So that's giving a little bit of a boost to the curve.
Right.
There may be something else to add. I mean, if you look at sort of the spot behavior these last couple of moves, up, and then vols get immediately sold down, spike down, vols get immediately sold down. Any spikes in front end are getting crushed pretty quickly, and that's the sort of the real reflection of market maker positioning.
Yeah,
Right.
to add on to that, like on the weekends, you can actually see that the vols are marked down heavily, like for the past couple of weeks, and we haven't really seen much weekend moves for like past 1 month or so. Like things been like just trading one line on a Saturday and Sunday. So you can actually see that dealers are actually like marking down the gamma and trying to reduce paying decay over the weekends and buy back on a Monday. So naturally, I agree that, we are seeing quite a bit of supply in the market, especially when the borrowing and lending market is like sort of gone now in the crypto space and people are looking for yield by selling puts and calls.
Right. Let's say that we had, we have like a 20%, sort of rally. So you're saying that the market's quite long gamma at the moment, but, we've been talking about all this like October call buying, for example, and I certainly know that, some of your market maker competitors or, even the takers that are active, in these sort of trades hold this view that action could get squeezy if we do get a rally that approaches a strike. So do you think if we do rally, we do get to the point where we could really see, significant spot up, vol up perpetuated by, this gamma feedback loop?
Absolutely. I mean, it's classic gamma, right? Well, once it tends to concentrate in particular areas. As soon as you get out of that area, suddenly, the long accounts have sort of lost their gamma, and everyone else is trying to buy.
Right.
So I'm sure we've all seen it enough times in various markets. These sort of spots are very, very sticky for an extended period of time as the gamma grows and grows and grows, and then there's some trigger that gets us out of the range and then accelerates that. And I think in particular over the next quarter, any acceleration on the top side could get quite. I'm not going to use the word parabolic, but overused maybe. But anyway, it should have some weight behind it.
Right. Yeah. And I guess the question now is what is it that gets us there? I mean, even we saw, after the grayscale news, which was supposed to be quite a positive development for the market, right? Aside after the knee-jerk reaction that we had, the move completely faded. And I guess is a good way to transition into what we're kind of hearing around like the FTX sort of stuff. I mean, certainly, a lot of news on Twitter over the weekend around it, definitely some FUD around, potential serious altcoin pressure, but, curious to hear what you guys think around this. I mean, my view, it's pretty overblown once you actually kind of look at the numbers here, but how are you guys perceiving it?
Actually, like it was I recall that the sell-off was overdone. Like it's not like the FTX guys gonna sell it, like let go everything at one shot, and they probably gonna sell it gradually. And so it was pretty oversold, and like what I said previously, and it was mostly perp driven market, and just small spot buying could squeeze things up. Yeah, so we are not too worried about that. We'll never know, like we still have Mt. Gox supply, but generally spot seems to be quite supported at this point of time. That's why we think that Bitcoin should be the outperformer on the top side, given that there's a lot of supply on the altcoins and the ETH side.
Right. I think in Bitcoin, I think they only have like 500 million or so. Right. So certainly pretty digestible, especially when, they're reporting that they're, in terms of crypto sales, they're going to start at like 50 million a week and then kind of ratchet to 100 and then 200. So it seems pretty digestible. Marty, is this something that you've been looking at?
Yeah, it just took more like the dumb approach, right? I was just looking at it and I was like, if they sell this all in one clip, then John Ray III doesn't have a job anymore. And that guy needs to milk this for as many years as possible, like he did Enron. And he's probably one of the best to ever do it. So, yeah, go look at like Mt. Gox distributions. Like 10 years later, they haven't even distributed. Like this guy's just going to keep milking it for as long as possible. If anything, it's already getting priced in and way overdone on that side.
Yeah, I mean, I agree. I mean, not even just John Ray, but like, you know, Galaxy that's going to be strategizing around these cells, right? I mean, they're going to be acting in an agency capacity around, you know, these liquidations. It's not like they're going to be able to buy it. They have $300 million of cash on their balance sheet, right? So in terms of like facilitating this stuff, and I mean, it's just human nature. You're going to prolong the sale of these assets to earn the max AUM fees on this while you can. Like, why would?
And also the other side, if they keep holding, the longer that they hold, if they do capture this upside, and if there is the pre-rush into the halving, and you have the 2024 election, and all of these like organic, natural catalysts to the upside, not specifically to the downside, more to the upside, then maybe, you know, the balance sheet increases. Maybe they make money on the crypto, and, you know, maybe they can make everybody whole. That's like my dumb approach to it all.
Okay, awesome. Well, if we don't have any more thoughts on it, I mean, we're coming up on 27 minutes here. I mean, I know we've been keeping these shorter, a little bit more punchy, but I certainly like the format like this a little bit better. So if that's it, we'll leave it here. And you know, Simon, Junseo, thanks for coming on. We'll certainly be chatting a little bit later. And Greg and Marty, thank you again as always.